Okay. So now let us have a look at the actual questions, the required portion, right? So we're done with the general talk, just talking in general, but now we're going to answer the specific questions that were required. So there's a satellite division there, right? Then we are required to calculate the current. Do you see this? So you have to underline that, and you're going to calculate the current budgeted. So if you have to underline that and make sure that you're going to pick the budgeted information. That's very important because you don't want to lose marks after picking the actual. So the current budgeted internal transfer price per dish set for the year financial year 2024. So we have been given that information already. We are told that the satellite division sells to the set top division, right? So we are given that information. So we need to know at what price do they sell that. So if you remember, they sell them. Where is the information? There is some information there. Currently, the internal transfer price per dish set is budgeted to equal the full manufacturing costs. So full manufacturing costs will include your fixed manufacturing overheads, right? Right. So let's look at the manufacturing cost. So the budgeted manufacturing requirements per dish set, right, it's going to be 4.5 kilograms of round steel at 40 rand per kilogram. So this is your standard price, right? This is your standard quantity. And we told you that the standard cost per unit is going to be determined as your standard quantity multiplied by the standard price. So the standard quantity is 4.5 kilograms per dish set. All right. So 4.5 kilograms multiplied by 40 rand per kilogram. And we've said that you need to align the units of measurement. So the standard quantity is measured in kilograms. Then your price should be rands per kilogram. Right? If your standard quantity was measured in grams, then you need to align that and make it, your standard price should be per gram. So the units of measurement used in the standard quantity should align with the price. The standard price should be aligned. And we've taught that to you. So we wouldn't expect you to think, when you come across a question like this, we wouldn't expect you to think 4.5 multiplied by 40. All right, so that's your round steel. Then this guy here, it's 144, so it's given. I'm gonna put it as it is. Then this also is given, and it's 62 rand. Then direct labor, this is the quantity, standard quantity, 150. You see here it's minutes, so we have to align that, right? Because we can't say 150 minutes multiplied by 30 rand per hour. So if the standard price here is per hour, then the standard quantity should also be hours per unit, right? You remember that. Or we could simply say here is minutes, so we need also our standard price to be so many rands per minute, but it's generally more convenient to have it in terms of an hour. So because this is per hour, we need the standard quantity to be in hours as well. And then we're going to divide by, so 150 over 60 multiplied by 30, right? So those are simple things here. I wouldn't expect any of you to really think, to stop and think, because that's quite straightforward. And in this paper that I got, I didn't see the marks, but I don't know how many marks that was. But I don't know, but that was quite simple. So we're talking of the total, right? So the total will include your fixed manufacturing overheads, and this is the fixed manufacturing overheads per unit. You remember that our maximum, what is the basis for the absorption of fixed manufacturing overheads? The basis, remember that we did discuss that earlier, direct labor time. So we can determine the total direct labor time. Right. This is the capacity. We normally don't use the capacity. We want to use the budgeted direct labor hours. Right. But I think I saw somewhere where they say they are equal or something. I don't know. Now, this is the total budgeted fixed manufacturing overheads. So 6,600,000, not so. Then divided by the total allocation basis is total direct labor hours. So I told that we need 150 minutes per unit, right? And how many units do we need to produce here? Right. So we have a maximum of 1, what is that, 1.1, right? So I think we can use the maximum here, but in most cases, oh no, it's actually operating. No, sorry, my apologies. The division is already operating. It's not like we just given the full manufacturing capacity, but this is its operating capacity as well. So we can use 1.1 million. So we have 1 million, right? 100,000 is that 1.1 million, and this is the number of direct labor hours. But we know that each unit is going to take 150 minutes, which is 150 over 60, right? So the total number of units we can produce is the quantity of hours available divided by the standard quantity of hours required per unit. Then we can look at, so let me just take my calculator here so that I can be a happy person. Right, like we said, this is not necessarily the answers that the lecturers do have, right? Because sometimes we do make mistakes or they can make mistakes, but it's generally very, very reliable. What we're going to give to you is very reliable. It's not the exact thing, but you can expect to be over, like I can give you a general idea, like 95% accurate, you know. We can't deviate that much from the correct thing, right? But it does happen that we can deviate. It does happen a lot, right? So we have, right, in 1,100,000. I think, I hope I'm writing that right. 1.1 million, right? That's 1,100,000. Then you divide that by, the number of hours is 150, standard 150 divided by 60. So I have a total of 440,000 units that I can produce. So the budgeted production. Now I have changed these to units. Do you see that? Because I could have changed these to hours by dividing by, I could have the fixed manufacturing overhead absorption rate in terms of runs per hour, and simply by dividing by the number of hours, budgeted number of hours, right? And still I would need to determine the per unit as well. So I can use it as in this way. So I have 440,000. So I have 6,600, right? 6,600 divided by 440,123. So my overhead absorption rate per unit, fixed overhead absorption rate per unit, the OAR is going to be 15 rand, and this is part of the cost, right? So I have this cost here, I have that cost, I have that cost, I have that cost. Then I have the fixed manufacturing overhead at something like 15 rand per hour. Then the total is going to be your, what is this thing called? The required in the question. What's the required again? The minimum transfer price, which equals the total manufacturing costs. Right, so that would be the answer to what? To the first question, right? So we have this round steel, 180. The noise block is given. This is given. This we calculate. All right. This is given. We did calculate as well. We took the the budgeted fixed manufacturing overheads, then the activity level, the allocation basis, the total was 1.1. So in this calculation, then the tutor prepared it on the basis of rands per hour. All right. So it was 6 rand per hour. But here, remember that we're going to be allocating 6 rand per hour, but each unit takes 150 over 60 hours. So it's still come to be the same thing. Right, so I think this is our idea of how the question should have been answered. Right, and I believe it's correct. Right, so that is the first question. Then the second question, question B, then that's like mindful of the limitation of the budgeted direct labor assembly time, which leads us to 440,000 units. All right. The satellite dish, this guy, manager said, the current budgeted internal transfer price is not fair. All right. Then the set-top division would be paying more if the minimum transfer price principles were applied to determine the internal transfer price. So for this question, assume a budgeted external selling price of 510 per dish set. Then comment on the correctness of that. Right. So this is a not so straightforward question, but it has a communication mark because you have to comment. Right. After calculation, you need to do a calculation and then make a comment. So what that basically means is you're gonna get some marks for calculations, and your final answer might be wrong, but your comment has to be in line with the answer you get. So when you make a comment as to whether you agree or disagree, your comment should be aligned to the answer you get, whether that answer is actually correct or not, but you should get the communication mark. Right, so basically this question wants us to apply the minimum transfer price principles and determine what the price would have been. And as you know, your minimum transfer pricing principles is that we need to cover the loss that we make, all right, in selling. And so the loss that we make in selling to the internal division is going to be your right. I want to think in terms of, all right. I don't want, sometimes I say, sometimes then you see they say variable cost of production, and I don't quite want to use the term variable cost of production. So I want to say the incremental cost of production, because all variable costs are obviously incremental. So I want to say the incremental cost of production must be covered, right? And then the lost contribution must be covered. So that is the total cost that has to be covered. And it's going to be covered by the total number of units transferred. All the units transferred should cover that. So if you want the price per unit, then you divide by the total number of units transferred. Then at least each of those, if we spread to each of those transferred units, that's the minimum price. It must cover the incremental cost of production. Sometimes we have the temptation to say variable costs, but that is not 100% correct, but we can use the term variable cost, because if we use the term variable cost, it's easy for you as a student to quickly remember which ones are the variable costs of production, right? Remember, these are variable costs of production, not just variable costs, right? And then here the lost contribution will include any contribution we would have gotten on things that we sacrificed, right? Or the units that we sacrificed, we didn't sell. Right, so for us, the starting point in a minimum transfer pricing then is to determine, was there any sacrifice made? Right? So that's our starting point. So the maximum that the entity can manufacture is 440,000 units. I think this is what we got there earlier. This is the maximum available hours, and each unit is going to take so much hours. So this is the maximum. Then the external demand the external customers. I think I saw somewhere where we are given the, all right, where is it? I think I saw somewhere where we are given the external demand. Yeah, the external demand is 144,000. Right. So my apologies, I have to restart. So capacity, it's 1,1 M over 150 over 60. So I got 440,000 here. Then external demand, what's that again? 144,000. Then because we are going to prioritize the internal guys, so internal demand, the internal demand is given, right? I think I saw it when we were doing that general talk there. I remember I saw it somewhere. The internal demand for the, what is it, the set top division. All right. Where is it? Because we want to determine the, so I think this is 336. The problem I have is that I don't want to go back again and read the background information. So I'm going to assume that that is the satellite dish top. The satellite dishes are going to be the same for both of these, right? That's my assumption. I don't think that it's just for one of them. So if it is for both, then we need this 336,000. This is what is budgeted. So we have to provide them with the 336. That's what I saw, right? Am I right? 336,000. So we have to provide the external market and the internal market. But because we're prioritizing the internal, any deficit is going to go to the external. Right? We have to satisfy the internal department first. So we have 440,000. 440,000. Then we subtract 144,000. Then we subtract 336,000. Then I have 40,000 that I'm going to sacrifice. So these are the sacrificed units. In other words, we're going to withdraw 40,000 units from the external. We would have sold these to external customers, but because we prioritize the internal department, we're going to give to the internal department. So we're going to lose out on the contribution for this. Right. So what do we want? The units being transferred to the internal department is 336,000. So this 336,000, we need to determine the cost of production for 336,000, the incremental costs, right? And then the lost contribution. And the lost contribution applies to 40,000 units only. In terms of the contribution per unit, so that is the total contribution. Then at least we must cover this. So all the units we're transferring is 336,000. And if we want to put a price on each, then we spread that cost that we need to cover on the 336,000 units. I really don't want to go into the depth of explanation here. You know, I don't want to do that because we have covered this the whole year, and there were some students who pulled surprise passes. You know, during the whole year they were quite struggling, but it's quite amazing how they pulled up a pass at the end. Right, and if you followed the tutorial program, don't expect you to have suffered, because with MAC you need to know your weaknesses. So you can't know your weaknesses on the day of the exam. So when we give you the exercises, you guys must make sure you submit them so that you can perfect your own work. You can know your own weaknesses and be guided by the tutor in time. Right, so what are we doing here? Right, so we need the incremental cost of production, and the incremental cost of production are going to exclude your fixed manufacturing overheads. Right, so if you remember, let me just look at something else here. we given some information, right? 27 rand 50. Was there something that was changed in the question? I think they changed something there. Okay, we are given the selling price, right? We are given the selling price. So the budgeted selling cost is 27 rand 50 per dish set. So that's going to be a variable selling cost, because variable selling costs or variable costs are going to vary per unit. All right, they vary per unit. So that means that this is going to be a variable cost. So for us to determine the total cost of production, remember I said it could be so the cost here is 476, right? That's the cost of production. But now when we want to determine the minimum transfer price, we're going to use only the variable cost of production. And I said to you, I prefer to use the term incremental, but in most cases, they're going to overlap perfectly. So I'm going to subtract 476 minus 15. Right? Then everything here is going to be my variable costs of production. Right? So I have 476 minus 15. So I have, the cost of production I have is 461. The selling price, remember, it's given to us is 510. So that's going to be our selling price. Then the variable production costs, I just removed the fixed manufacturing overheads, right? Then the variable selling costs we are given there. Then the contribution is 21 rand 50. So we say the minimum transfer price should cover the variable cost of production and the lost contribution. Right. Then so I don't know if I did this right. Right. This is the unit sacrificed, which we already calculated. So the variable cost of production is going to be equal to 461, right, multiplied by 336,000. Right. That's the total variable cost of production. Remember, this 336 is what we're transferring. And what else do we need to include here? Lost contribution. The contribution is 21 rand 50. The unit multiplied by 40,000 units. Right, and whatever we get here. Then we get a total of the costs that we need to cover. And this total has to be spread over the units being transferred. 336,000. Then we get the minimum transfer price. All right, and the minimum transfer price is going to be equal to. This is what I got. And I remember I always say we can't say this is what the lecturers have. Yes, because when I'm reading through there, I might miss some information. And, but in terms of principle, remember we don't really want the actual answer. Because if the actual answer is, for example, 470, right? What are you going to do with 470 in your future examination? Because it's not like the minimum transfer price in the next examination is going to be 470. It's the principles that should define what we're doing. So in terms of the principles, this is exactly the approach that we follow. So, and I also believe that this is all right. So there's a tutor that prepared this, one of the ladies, and I think that's correct, really. Right. So that was the question on what? On the budgeted minimum transfer price. Then you were supposed to comment, right, whether it's fair. So the old one, the old cost was what? Was 471. Right. But now if we use minimum transfer pricing, it's going to be 463. So it's actually not correct. Based on this information we have, we can say, oh, well, they wouldn't pay more if we used minimum transfer pricing principles. They would actually pay less. Right. So there is the question and the comment. Then we have the setup division. Right, setup division. Then there's some intense negotiations that go on there. Then this guy agreed that a fair budgeted internal transfer price is 470. So remember that this internal price of 470 per dish set is revenue to the satellite division, and it's a cost to the setup division. So that's the cost of the inputs that they need to buy from the internal department. So now we need to calculate the budgeted, and it's a calculation, the budgeted number of units per product type that the setup division will need to manufacture and sell to achieve the division's target profit. And what an easy question that you guys get, that you guys got there. This is easy. This is absolutely very, very, very easy. And if you want to pass the module, these are the things that you have to survive on. You cannot let the marks elude you from here. You can't miss these marks, because this is what you do from the very beginning. I mean, if we do intakes in December and January, no, actually December. So early on, so if you join early or whatever time you join, you start this thing from as far back as March. That's the first topic you need to you go through, right? And how do you explain losing marks on a question like this one? 10 months later, you're being examined on something that you have been doing, right? So as you guys know, it's going to be very easy. You need because there are two units, two products that are being that we're looking at. So the first thing that you need to determine that you will need the total fixed costs. You will need the total fixed cost plus the target profit. That's one of the things you need. And remember, here we're saying total fixed cost, not just total fixed manufacturing cost, but all fixed costs. You should be able to pick up which costs are fixed, which are not fixed. Then you will need your contribution per unit for both. So you will need to determine the contribution per unit for each. And I was just going to go now to talk about the what's this thing called? The optimal production mix, where we have the contribution per limiting factor. But it's not what this question requires. Then you calculate your sales mix, which we have to calculate. We did calculate, right? Your sales mix. And you multiply your sales mix by your contribution per unit. Then you have your weighted contribution, right? Then you get a total of the weighted contribution, and then you divide by that. That is so simple. And that is where you need to, if you come across a question like that, you need to push up your marks based on that, all the way up. Brilliant. So let's do that quickly. So I'm not going to I don't think that this is a long question, really. All right, so let me just go to the setup division. So the sales mix, we said it's 4:1, if I still remember. The selling price per unit, remember this is budgeted, we said budget. The selling price per unit is given, right? I think this is we don't have any information on the question that says for this question use this. So I think we can use this one as the selling price. Then the dish cost per unit is given as 470, right? After that negotiation, right? So this is variable because this is a direct material. Then this is also given. Nice. Fixed manufacturing overheads won't enter in. Then the total selling costs, it's per unit, it's R7, the variable. Sorry, I said total. Variable selling costs per unit, right? Is there something else that is variable? Then we get our contribution from there. Then our, what's that thing called? Our total fixed costs, where are they? Right, this is our fixed manufacturing overheads, 13. From here, we can determine the fixed manufacturing, fixed fixed selling cost as this total minus the variable, and the variable is 7 multiplied by that, 7 multiplied by that. Then the remainder is going to be the fixed ones, right? Then the allocated overheads is going to be 300,000 times 12. Remember that we said that because each division is going to get 300 times 12. Then we add the target profit, and the rest is going to be a poem. So that's quite simple. Let's see. Do I have it here? Right, so the selling prices are given. We saw this one, and this we are told to assume, right? So we're gonna assume nicely. This is given. This is given. I don't know if I might have missed something else, but this is the contribution that we have. Then the sales mix we did, it's 4:1. Then the weighted contribution, you multiply that, right, and you get this. Then you combine that, you get sum of the weighted contribution is 918. So that's quite nice. Then you come to your fixed costs, your allocated is that one. Your allocated is that one. Your fixed manufacturing overheads is that one. Your target profit is that one. So there is something missing here. What is that thing? The fixed selling costs. All right, so there is a missing fixed selling cost here. That's why I told you that there is a possibility that we can miss some information, but the principles are always going to be correct. So because this is missed, then the answer is going to be slightly different. So we said that it's how did she miss this one? I think it's just so we said, what did we say? Is it 10,800? Because I need to include it there. 10,800 minus 7 times 268,800. So I have 268,800. That's the total number. Yeah, 268,800 plus 67,200. So I get 336. Oh, by the way, it's actually given as 336, right? So I need 336 units being sold each at 7 rand. So I multiply that by 7. I get 2 something. Then I subtract 10,800. Then my fixed selling costs, which we missed here, it will be 8,448,123. Right. So which means that the total is going to change. But now we're going to still calculate on the basis of this total, because we're going to demonstrate the principle. You would use if you want to write up some memo for yourself, you would use this adjusted one, right? So break-even batches is going to be equal to the total that you get here. But now, like I said, we're going to be using this total. So it's going to be 21 over the sum, right? And you get the break-even batches. These are the batches, right? Is 22,146, and you always round up for contribution. You round up, then you get 22,147. Remember, you would get a different amount here. You will need to remember it would be slightly more than this. Then now you know that we're going to produce 22,147 batches, right? 22,147 batches. Then each batch will contain 4, based on the sales mix, 4 of this and 1 of that, right? So that is what we will have, right? And the proof doesn't quite really work, because it's always going to give you the answer that corresponds to your input, right? So if your input here is 21,704, then you're obviously going to cover that, right? So remember, the final answer, like I showed you here, will be slightly different from this one, based on these fixed selling costs which were not included. But don't worry, if you would come across a question like this and you miss something, because these things depending on how diligent your marker is, because these guys use markers, and these markers are not lecturers, correct? So because some people will not be able to follow through, because what a marker is supposed to do is if they see that, for example, you missed selling costs here, and then you lose a mark for that, because maybe there was just a mark for that, you lose 1 mark. But now the marker is supposed to stop following the memo and follow your working based on the memo, based on the principle on the memo. So you're gonna apply this correctly. So you're gonna get marks for this. So the marker has to now mark your work based on principle. And I'm not always sure these guys have the diligence to really follow through your work. I doubt. Perhaps that is the reason why there's a lot of failing. But I don't know how diligent those guys are, because now that would be extra work on the marker, and I don't know how they are paid. Are they paid on the number of papers completed or completion time? Because I think it would be very difficult, because every student, will have their own answer. One student is going to miss out on selling costs. The other is going to forget target profit. And then you follow that student's calculation. And you have to do calculation to see if this is correct, if this is correct. And the other student might miss allocated head office costs, or whatever it is that they miss. And so I think that the markers would obviously be exhausted trying to follow each student for each question. That would be quite a challenge. Right, so maybe that's why there's a high rate of failure in the MSCs, because they might just say, well, if you don't get it right, I'm going to be lazy. Then we required to prepare the actual statement of profit or loss. Remember now, that is where you need to remember that what is this thing called? The costing system is absorption costing, and the costing system is absorption costing. And the format has to follow absorption costing. And because this is the actual statement, you're going to enjoy including your, what is this thing called? Your over or under absorption and other guys. And do they use the weighted average method? Do you remember that? So which means that the valuation of closing inventory will include the opening inventory values as well. Right? So things that you would have alerted yourself when you saw that it's absorption costing, it's the weighted average. And they want this for the set-top division for the financial year 2024, and comment on whether the division has achieved its target profit. And I've said to you, you always get a mark for commenting, right? Whether your answer is wrong, but you comment, and your comment should be in line with the answer that you got. Okay. All right, so that's going to be a very easy job for us to do, preparing the actual statement. And I'll always remind you that you would underline the word actual, and you picking up your figures. You picking up the figures. You wouldn't want to pick figures from the budgeted and then lose your mark. So just be on the lookout for that. So this is the set-top division. So let's go to the set-top division. Let's go to the set-top division. Right. So what we're looking for is the actual, right? So this is the budgeted. We'll come to the budgeted when there's a relationship between the budgeted and the actual. But otherwise, we're going to focus on the actual. Right, where is our starting point again? Our starting point is the sales units, right? The sales. 1,400 per unit and 1,300 per unit. So now I know that this is what was actually sold. So 240,000 multiplied by that price that we saw there, 8,000 multiplied by that price that we saw here, right? And I am very careful to allocate the selling price of DFTV to DFTV, right? The one for 1,300 per unit is open watch. And, right, so I know that I got that right. What's happening here? There's something that I wanted to talk about. Let me try to think. Oh, yeah, it's fine. What does the question say? I need to check the question, and I think there's something I want to point out. Only the total column is required. This is what I wanted, right? So the total column is required. So what you would do, what I did is that I didn't prepare what the tutor did in this question is that she didn't prepare the total column. I think she didn't prepare the total column because it's more like demonstrating the calculations. Only the total column is required. That's very easy. But in your calculations, you have to, so this is the total column for presentation when you present the income statement. But when you do your calculations, based on what is this thing called? You have to do for each, right? You have to do for each product, sales units for each product, and then you transfer the total to the proper income statement. But when you do your calculations, you have to do calculations for the right for individual for the two products separately, and then you combine them. Right, I'll show you what I'm talking about here, because this is very important. It's particularly important when you're dealing with the valuation of closing inventory. Because now, if you haven't followed that, you're going to struggle. Because remember, you're going to have closing inventory for DFTV and closing inventory for the other guy. So you will need the production cost for each one separately. And if you had not been careful to separate them, you have to recalculate them. And that's not happy. That's not very happy to do that. So in your calculations, although the total column is required, in your calculations, you show your, you have to keep each one separate. It's very important. Right, let's go to, I think this is very easy. Let's go to the opening inventory. These are units, right? So we need to determine the value. You guys failed this module, but what a wonderful module it is. So the opening inventory is 17,155. So don't be fooled into just saying it's 17,155 and you put in that 17,155. You need to follow and have a calculation. So let me show you what we did, which is what I am talking about. Right, so this is what is required in the total column. Right, but I don't want you, when doing your calculations, this is the calculations. Remember, I did them in here, but I would expect you to do them in a separate page and transferring the totals here. So you would have in your calculations, this is maybe DFTV, this is the other guy. Is it open TV? So you need your opening inventory like that in your calculation. Here you put your totals. Because if you just go in and put your totals like this, there will be a time when you will need these figures and you can't get them, and you have to now start recalculating them because you didn't specify which one belongs to which product. So it's very important. When they say the total column, in your calculations, please present for both. But in your presentation, then you wouldn't include this, because you can come across people who are crazy and they will penalize you. Right, so that's what I wanted to highlight to you. Then, right, that's our manufacturing opening inventory. Then we're looking at actual. You remember that? That's what we want to do. Right, so this is interesting. I don't understand. Okay, I do. Because this, I'm seeing here direct labor costs and total variable manufacturing costs. I'm saying, what is that? So this is just for us to calculate the applied fixed manufacturing overheads. All right. Okay. So this is easy. So the total variable manufacturing costs is this and that. So it's given. So we're just gonna go and put them like that. The total variable manufacturing costs. Then on top of the total variable manufacturing costs, we need the fixed manufacturing overheads and how are they being absorbed on the bus. Remember that each division might have their own basis for the absorption of fixed manufacturing overheads. They might have their own fixed manufacturing overheads and their own budgets. So we have to recalculate for each division where necessary. And so we have budgeted annual direct labor time. All right, so we have to go back now and go to the budget. Right, so in the budget, we're saying, what are we saying here? What's budgeted direct labor? So it's 1.4 per unit, 1.4 hours per unit. So I'm planning to produce 268,800, 268,800. You will know that this budgeted production basis is based on the manufacturing units. So when you want to determine how much production is going to happen, please always choose make sure you point into the manufacturing units, right, not the sales units, because it's easy to accidentally pick the sales units there. So it's 1.4 multiplied by the manufacturing units, which is that. So the number of hours budgeted plus 67200 multiplied by 0.9 per unit, 0.9. So what I get here, I don't know if it is correct. This is a 436,800 or whatever you get. Then the fixed manufacturing overheads is 13,104. All right, 13,104. All right, 13,104,000. You divide by 436,800, and you're gonna get this as per hour, right? Runs per hour, because this is the total number of direct labor hours. So it's 13,104, 1, 2, 3, divided by 436,800. So it's 30 runs per hour. Now the pay is very important, because you need to determine exactly how do you do your allocation basis. So it's 30 rand per hour. Right, so for every hour, we're going to allocate 30 rand. Now we need the actual number of hours to see how much did we really allocate. Because for each hour, actual hour is 30 rand. So what do I have here? Don't understand this. This is direct labor hours per unit. Right, so I'm going to test this if this is correct. So I produced 250,000 units, right? 250,000 units, each taking 1.1 hours average, 1.1. So it's 275. Then I'm not sure why they gave us this and that and that. All right. So it's 275,000 actual hours, and I assume here it's also 75,000 actual hours. So for this guy here, it's 275,000 actual hours. And for each hour, we're applying 30 rand. You will remember that. Then this guy here, it's 75,000 hours. And for each hour, we're applying 30 rand. So this is what we applied. Right. So I have 275,000 multiplied by, 275,000 plus, all right, 75,000. So that's 350,000. Multiplied by what? By 30. So I applied 10,500,000. So this is what is included in the cost of production. Then I'm going to check what's the actual. So the actual is actually 10,200,000. So this is what I applied. So in other words, my cost of production is 10,500,000. But it should be 10,200,000. So the fixed manufacturing overheads included in the cost of production is 10,500,000 instead of 10,200,000. So this is too much. We need to reduce it because we included 10,500,000 instead of 10.2. So this is an over absorption, and an over absorption has to be deducted to reduce cost of sales. And if you reduce your cost of sales, that means you are increasing your gross profit. Right? But then let me what else do I need before I go? So the total selling costs is 10,100,000. You should be able to distinguish between, come on, for an actual costing statement for using absorption costing, there's no need to distinguish between the variable and the fixed. Really, there's no need. But I do see sometimes the lecturers split into variable and fixed. Then the allocated overheads, we have them as a cost. Then all right, so basically that's everything. Then we come to closing inventory units. Very important. It's given. So because we use absorption costing and weighted average, let's just go to the actual calculations where the figures are, and we can do our stuff there. Right, so this is given, right? This was given, right? This we did calculate just now, and the total became 10.5. And you see now we need with the total cost, see the total cost of production? No, this figure here, this total here, includes the opening inventory. And we are including opening inventory because we're using the weighted average method. Right. So how many units did we produce? Right, so this is much better. Let me just go back to the question. I might have missed some few things that we want to apply. Budgeted. This is the actual. Right, so we need now the actual units produced. It's 250 plus 75. So what we had available, we originally at the beginning we had 5,000, then we produced 250 more. So the units available during the year, the total is 255,000. And for this guy, the total is whatever. Is it 83 or whatever it is? Then we have 15,000 units remaining, 3,000 units remaining. Brilliant. So let's now go and apply that. Great. So the total cost, the total value for all the units we had for the year, including our opening inventory and the ones that we produced during the current year, the total is this. This is available for sale. And then we need to determine the average cost per unit. So the average cost per unit will be this figure here divided by 255,000, the total number of units available during the year, right? Then this one will be divided by 83,000, the total number of units available during the year, right? So I think this is the calculation. Right, so for DFTV, we have 255, and this is the cost of all the units. You remember it's here, 352,665. It includes opening inventory because we're using weighted average. If we were using first in, first out, this figure here would exclude your opening inventory, and then the calculation would proceed exactly the same, except that for first in, first out, we would have excluded the inventory, which is not technically correct to say that for first in, first out, we use, what's this thing? We exclude opening inventory. We don't necessarily exclude opening inventory, but if we say we exclude opening inventory, we could be 100% correct based on the questions that the examiners have produced. But technically, that's not what FIFO is about. But I will say that is what it is about because that's how the lecturers teach it. That's how it's presented in the examinations, right? So where are we? Right, so we were determining the cost per unit for all the units in inventory. So we take this divided by the total number of units that we had, right? So it's 255. So if we were using FIFO, we would exclude opening inventory units, and opening inventory values would also be excluded. So it's the total value of all the units we had available divided by the total number of units available. So we get a cost per unit. So the average cost per unit is 1383, and we have 15,000 units in stock. So this is what we have. We do the same here. The units available, opening inventory plus closing plus production units. This is the total number of units available, and the total cost including current cost of production plus the value of opening inventory, and we divide by the total number of units available because it's weighted average method. So the cost per unit, the average cost per unit is that amount. Well, we still have 3,000 units, each assumed to be valued at 1280, and this is what we have. So now we have our closing inventory. If you remember when we said that it's important to check which costing system is being used. Right. Okay, and which costing system is being used as well as the cost flow assumptions. So we have spoken about this, all right, applied to DFTV, fixed manufacturing overheads applied to DFTV, those applied to the other guy. So this is the total applied, the actual, then this is an over absorption, which you must reduce from your cost of sales. Okay. So we come here and we say over absorption, we're subtracting from the cost of sales. Then everything here, you want to say your opening inventory plus this plus that minus closing inventory minus over absorption. You get your cost of sales. Then you get your gross profit. So this format follows absorption costing. All right. It's a format for absorption costing. You will have cost of sales here. You will have fixed manufacturing overheads included. And if there's an over or under absorption, you will have it there. Then here you will have gross profit. If you were using direct costing, then this would not qualify to be cost of sales. Maybe variable cost of sales, right? Or yeah, I think we could say variable cost of sales. Then here we wouldn't have fixed manufacturing overheads included. Then here we wouldn't have an over or under absorption. Then here we also would have variable non-manufacturing costs, like your variable selling costs. And then we would have not gross profit, but contribution. But because we're using absorption costing, here we're going to have a category for non-manufacturing costs. Whether they're variable or fixed is not important. They're just non-manufacturing. So you have your allocated costs given, total selling costs given. And like I said, it's not absolutely necessary to distinguish between the fixed and variable. But I do see in the memos, the examiners distinguish variable selling costs, fixed selling costs. So you might want to do the same, because I'm not the lecturer, I don't award the marks. The lecturers do award the marks. So they probably could be awarding you the marks for splitting that. All right. So we say that we have this category called less non-manufacturing costs. If it was direct costing, then we would have less fixed costs, because all fixed costs would come together, whether it's manufacturing or not, as long as it's fixed. All right. Then what else did I do here? Because I think I was hoping to include the profit under direct costing, some kind of reconciliation, but then I don't know, I didn't do that. Right. So basically that is what we have. All right. And like I said to you, this is correct in principle. You can even expect this to be the correct answer, right? Because we actually don't think we missed anything here. And then the final question was saying that you must comment on whether they made sense of the 5 million profit, right? And you have to make a comment based on the answer that you get, and then you're going to be very happy, right? And now we're moving on. I just want to complete this quickly, because we can't go on forever. All right, so I have to complete this quickly. Right, so it was ridiculous that actually the income statement and its calculations is 8 marks, but there's a lot of calculations that have to be done, especially with your fixed manufacturing overheads and closing inventory. That's a lot of calculations, but yeah, it's fine. So then the next question, so I'm going to that's much better, because it's just this EF. Right. Identify the responsibility center for the technician division and provide reasons. Right. And then with reference to performance measures in the scenario, evaluate whether it's justified for this lady to be skeptical of the current performance measurement and reward. Support your evaluation with brief calculations. So I'm not going to really focus much on that. From practical personal finance guidance that these guys can develop to assist installers. All right. So it's something that is not really costing, but it's practical things that people have to come up with in a world. So let me go to the actual information here. So we've been told that they're using net profit before tax and bonus to reward divisional performance, right? So what was the first question again? The first question said, find the responsibility center of the technician division, right? And so there are a lot of, what is that? Responsibility centers. There's a cost center, there's a profit center, I think. Cost center, profit center, there's an investment center, right? And we have actual information for the financial year 2024. So this is a question of judgment, right? Where you have to make a judgment. And the judgment is not going to be necessarily wrong or right, depending on how you support your answer. Because that's what they say here. They say identify the responsibility center and provide reasons to support the type. So you could provide in a center that is different from someone, but then you provide a motivation like, I did that because I saw A, B, C, D. And you could, I don't know the actual memo that they have, right? But it depends on your motivation to some extent. So I would think this is an investment center, but I'm not saying this is cast in concrete, because it all depends on your reasoning. So if you look at the technician division, I would think this is an, what is this called? An investment center, because in an investment center, the manager will have certain control, right? Certain control over certain things. So the manager should have control over controllable costs. So if you look at wages for installers, and they are the ones that hire them, right? So they have control over that. And then they earn revenue by installing. So they also, an investment center is going to earn income, right? Right. So it will have, I don't know here if they have control over the prices, but an investment center should have that control over the prices. Remember, I didn't say this is what the lecturers wanted. This is what I would have answered that way. So let me see what else they have. All right, so this is going to be non-controllable. And if we look at the ways we can measure, if you look at the actual information for this technician division, we see that they actually have controllable profit, then they have controllable investment, they have a residual income and a return on investment. So you can see that because it has control, the division has control over some investment, and it has control over some profits, then we can actually use a residual income based on the performance expected on it. I think this would suit an investment center. Right? Because in an investment center, let me just see what the lady prepared for us here. But remember that I'm saying this is not necessarily what the lecturer said you should have. So the lady prepared this. She wanted us to focus on whether the manager has control of controllable costs. Do we have any controllable costs? Yes, we do. Because that's some of the identifying marks for any investment center, right? Does the manager have control over sales generations? So we saw that the manager does have the control of that. And they do invest in non-current assets. They have control over investment. Because we saw there's a controllable investment. So that would suit an investment center where you actually do make investments and control costs and generate profits, right? So that would be an investment center. But I think you can also choose something else here and be able to support yourself. But I think this is more likely an investment center. And then the other question was saying, a reference to the performance measures evident in the scenario. Is it justified? Well, and they say you must do calculations. I didn't like to read this. Right, so we have the net profit before tax. I think it's or before tax and bonus is after accounting for the insurance premium of 450, all right, and head office of 372. So you see there that we have a net profit before tax, but we could calculate controllable profit, right? If we calculate controllable profit, then we have to adjust for what is not controllable included in the insurance premium, and these head office costs are also not controllable, right? So we would have to add them back, right? Right, and we see that performance bonuses were paid by head office to divisions that achieved a minimum of 4 million, right? So these guys, how much did they achieve? A million. Technician, right? It's 830. Is that correct? 4 million rand. So if you look here, then the satellite division got that. I think they measured the, what is this thing called? They reached they met the criteria. They qualified for this performance bonus, right? Because it was over 4 million, but this technician division got 830,000. So now we have to determine if they had used other stuff like controllable profit. You see there, it was going to be 4685, and then they would have to, because that is what they could control. So they might have earned that, what is this thing called? The performance bonus, because they actually meet this. If we adjust for the cost that they cannot control, and these ones wouldn't meet, this one wouldn't meet that, right? Because it falls below, and this one would meet that 4 million rand benchmark. And the problem with discussion questions is that you don't have what you would say is the answer. Right, suppose it's an issue of judgment, and judgment isn't going to be the same. And so these are some of the questions where you can try to, all right, get as many marks as possible, but you may not always get all the marks. Right, what else do we have to cover here? All right, so this is about financial. This is about financial. Personal finance planning things. It's something that you just have to come up with in the examination. It's not something that you have to be prepared in advance as to whatever question they might ask you. But basically, so this was the discussion. I want you to go through your answer that you submitted or during the exam, and see if there is anything that you can add to your understanding. Then the next, we're going to do the finance part as well.